Okay, in this tutorial, we will be identifying what a push phase is in our area of interest. We want to identify this phase to remind ourselves not to enter until the banks create liquidity. By doing this, it gives the trader the opportunity to trade toward liquidity, which helps minimize drawdown. All right. Now, when you are identifying an opportunity in your area of interest, you will most likely have the three arrows, you'll draw your vertical line, and then you'll have to understand what phase the market is in before entering the trade. And the reason why you want to understand what phase the market is in before entering the trade is because if you enter the market in the wrong phase, it will put you in drawdown. And when you get put in drawdown, especially if it's significant, you start to second guess your analysis. And what happens is you either close too soon or you'll protect the trade by putting your stop loss too tight and you'll get stopped out when you were right about the analysis in the first place. All right. Now, the push phase is what I have highlighted here in blue. And this is the phase that creates FOMO because it's usually some form of a strong push making you think you're going to miss the move. Now, if you look at price in a downtrend, the market does not move in a straight line. So it's going to give you multiple opportunities to get into the trade before it takes off if you're on time. Now, as you can see in this bit of price action here, we have a lower low, a lower high, a lower low, right? A lower high, a lower low, a lower high. Now, every time the bank creates a lower low, that is the push phase. All right. Now, I can show you this multiple times in this price action. If I take this box and move it to this area, these series of purple candles that break structure is your push phase, right? These group of candles is your push phase. Once the market starts to push, what's going to happen is it's just going to produce drawdown. And if you don't enter the trade in this phase, it'll give you the opportunity to enter the market in the appropriate phase where you'll minimize drawdown and trade with the banks. All right. Now, if you notice in this diagram where I have this blue box, it's highlighting the push phase. And then notice the next phase is where the banks create what I call liquidity. Now, the reason why they create liquidity is because the banks need a reason for the market to go down. All right. They need a reason for the market to go down. And that reason is to collect orders before they actually take price in this downward motion or in this downtrend. All right. Now, looking at this bit of price action, notice we get a strong push to the downside that breaks below a low, right? When price breaks below a low, that is a liquidity grab. We had buyers that bought, right? This push phase stops the buyers out. In order for the market to go lower than this point, the banks will trick buyers, retail traders that will buy off of this support. They'll trick buyers, and that will cause price to pull back. When the market pulls back, your entry is going to be at the peak of this pullback. That way, you have liquidity to trade toward. Below this wick will be liquidity where the bank will collect its first order. What I normally put below this wick is what I call an RTD. It is me identifying that the market has a reason to drop after the banks pull price back, trick buyers to create liquidity. Now notice right here, it says entry. Your entry, it needs to be in this area or anywhere before price breaks below the RTD. And as you can see, if you enter here, you get a nice entry with minimal drawdown. The market actually starts to makes lower lows and lower highs, lower low, lower high, and the market takes off. All right. Now, when you enter here, aggressively, your stop loss can go a few pips above this wick. Conservatively, it can go above the previous high. maybe start with a small lot size, and as price makes its next lower low, you can add a heavier lot size as you know price is ready to take off. All right. Here's another example. All right. Notice our signal came in. I drew the vertical line. All right. We can see change in momentum from the three indicators here at the bottom. Notice that we are overbought. Notice the signal line is outside the MACD. And notice this indicator did flip in our area of interest. Now, once we have all three confirmations, what we have to do is we have to look and see what phase the market is in when we get all three confirmations. And right around this area, notice where I have it highlighted in blue, we have consecutive purple candles. We have 1, 2, 3, 4 sets of purple candles. And notice they all break below a low. We had a move up and a move down. This is an area of support. We broke below it. That's a break of structure. When we get that break of structure in a push phase, from this push phase, the next phase is going to be to trick buyers, right? Some form of a retail trader will buy off of this area of support. Now, if you enter the market in this push phase, what's going to happen is yeah, you'll go into profit. If this, if you entered here somewhere, you would go into profit, 11 pips. But then because the bank has to create liquidity, now you're in drawdown 14 pips because you did not wait for the bank to create the liquidity. So you have an order to trade toward, liquidity to trade toward. The moment the bank pulls price back below this low is going to be another RTD. This is how you'll be able to identify the banks creating liquidity and then giving yourself an opportunity to enter above the liquidity. So right in this area or at the moving average crossover, you want to enter your trade. When you enter here, stop loss can go above this high aggressively or conservatively above this high, right? Once you enter the trade, notice the bank will go past this low, collect the order, and then take off and go towards your take profit. Right? Now, these are two examples of it reversing to the downside. Here's an example of it reversing to the upside. All right. Notice I drew the vertical line. We have our signal. We're oversold. The signal line is outside of the MACD. We have bullish momentum in my area of interest. And then look where it's highlighted in blue. This is the push phase. All right. This is that phase that if you enter, you'll go into drawdown first before the market takes off. All right. Now notice this push phase breaks above these highs. Right. So we have a break of structure. The banks took liquidity from these sellers. Now, in order for the bank to go higher than this point, the bank has to pull price back. Once price pulls back, right, usually to an area of support, above this high now will be what I call an RTP. It'll be a reason for the market to push. The moment the bank tricks sellers, right, because now we have sellers selling off of a minor area of resistance, right, thinking that maybe the banks are going to continue price to the downside, them not knowing the market is ready to reverse will produce liquidity above these highs by protecting their trade. So when these guys sell, there's a stop loss above these highs. Your entry is going to be down here in this area. You always want to enter below your RTP so you have an opportunity to trade toward liquidity. And as you see, if you enter here, your stop loss can go below these wicks aggressively or below the entire previous structure conservatively. And as you can see, market goes straight up towards your take profit, right? What you have to identify is that push phase after you get all three confirmations. All right, let's look at another example. All right, now this one is a trend continuation example. And as you can see, right in this area, we are overbought. The MACD has already flipped because we are in the downtrend, and we have bearish momentum in our area of interest. Now notice the market went into a push phase, highlighted in blue. The push phase always will be the phase that breaks below some form of a low. And as you can see, we did break below this low, taking liquidity from these buyers. These are retail traders who bought off of a minor area of support, thinking the market was going to reverse. This push phase stops these guys out. Now, in order for the bank to go lower than this, the bank has to do what? Create liquidity by tricking buyers, right? Below this low will be your RTP, right? Will be your RTP. Your reason for the, actually, that's wrong, excuse me. Should be your RTD. Should be your RTD. And then your entry is going to be up here or right at this moving average crossover before price breaks below this low. All right. Entry will be here. Stop loss can go above this wick conservatively, aggressively or conservatively above the previous high. And then, as you can see, market goes straight down. All right. So hopefully after watching this short tutorial, you have a good idea of what the push phase is, and now you know why you don't want to enter in these phases, because what our goal is going to be at entry is to minimize drawdown and get into the market with the best risk to reward. All right. Hope this helps, guys.